Hello friends, this is also a quick recall of CAIIB risk management frequently asked questions. This is the third part. Okay, we have released the third part. You see here question number 29. So see, this is the 29th question. The question is leverage ratio is calculated as leverage ratio. What is leverage ratio? As answer you can see, I will not read the options. You can see directly the options. So the answer is the one which is highlighted in red color. That is the first option. Okay, exposure measure or its C. Why is it A? It's capital measure or exposure measure. Why is it A? It's because leverage ratio. What is leverage ratio? Leverage ratio has been introduced under, you may be aware of, leverage ratio has been introduced under Basel III as a risk management measure. Okay, so that is nothing but an independent of the RWA. Independent RWA calculation. RWA stands for risk weighted assets calculation method. Risk weighted assets calculation method. So leverage ratio is equal to capital measure or exposure measure capital. For this purpose is tier 1 capital after all regulatory adjustments. Kindly make a note, capital measure or exposure measure capital measure for this purpose is tier 1 capital after all the regulatory adjustments. So exposure measure includes the on balance sheet exposure, off balance sheet exposure including the derivative exposures as well as the securities financing transactions. I would repeat once again why the answer is 1 is because see capital measure. So what is capital measure? Leverage ratio is equal to capital measure. See, capital measure divided by exposure measure. Okay. Leverage ratio is equal to capital measure divided by exposure measure. Exposure measure. Okay. So, what is capital measure? Capital measure in that it will come the tier 1 capital after all the regulatory adjustments. Okay. And what is exposure measure? Exposure measure is on and off on balance sheet exposure, off balance sheet exposure. So on and off will come including the derivative exposures as well as the securities transactions or security financing transactions. So that's why the answer is capital measure divided by exposure measure. Second comes the, move back to the next one, net interest income. So what is net interest income? They have already given 4 options here. In the exam point I am saying you, see net interest income. So what is net interest income? There are 4 options. The answer is the one which is been highlighted in red color. Don't only see the answer. After that, see why the answer is that. The respective answer, why is that? There will be a reason behind it. We will just think of that. Net interest income. So what is net interest income? Net interest income is actually the difference between the amount of interest paid as well as the interest earned. Interest earned and interest paid. So the difference is the net interest income. That's why the answer is the last option D. Okay. The next question, a bank expects fall in price of a security if it starts selling the security in the market. See the question, just think the question first. A bank expects fall in price of a security. Okay, a bank expects, what he expects, fall in the, means reduce in the price of a security if it starts selling in the, market the respective security. So what is the risk that the bank is facing now? There are 4 risks mentioned here. You can see in the screen. There are 4 risks. The answer is market risk. Why is because, see, the answer will be, actually the answer is asset liquidation risk. Answer is asset liquidation risk. But see here first, the answer is market risk. So why the market risk? Market risk refers to the risk of a price of a security falling in general. So what in the question is been asked here, the price fall because the bank is starting selling in the security in the market, isn't it? That is when it is liquidating its assets, right? Liquidating its asset liquidation. Hence the answer is the option C, asset liquidation risk. I hope you are understanding my point. Answer is asset liquidation risk. But asset liquidation risk. But this case in general is a market risk. But as the bank is selling it and he is expecting, the bank is expecting the price fall or reduction in the price because the bank starts selling the security in the market. That's why that is itself means when it is liquidating its assets. Asset liquidation risk will come here into force. Okay. So answer is C option, asset liquidation risk. The next one is a fall in the interest rate will make prices of government securities, that is GSEC, government securities. Okay. What will it do? A fall in the interest rate. If an interest rate will reduce, will make the prices of government securities what? Go up or go down, or it will remain the same, or none of these. The answer is obviously it will be go up, because the market's interest rate and the price of a fixed income security is always inversely related. Please clear in mind, the market's interest rate, whatever the interest rate of a market will there, as well as the price of a fixed income security is inversely related. It's not directly proportional. It is always be inversely related. If the interest rate falls, the price of a bond rises. And if the interest rate rises, the price of a bond falls. So vice versa. Also make a note that if we are referring to a market interest rate, let's suppose market interest rate and not the coupon interest rate. Okay. I'm just giving you an example. If suppose we are referring to a market interest rate and not the coupon interest rate, which is payable on the security, that normally remains unaltered, or it will not be changed, or it will be unchanged throughout the life of the fixed income investment. Okay. So in general here, as per the question, fall in the interest rate will make the prices of GSEC will go up. Okay. So in this video, like in this slide, there are 4 questions we have already completed. We'll move back to the next slide with new questions. Now look at the screen. This is our 33rd question. So the question number 33. So what is funding risk? Okay, you can see the options. What is funding risk? See, funding risk. What is funding risk? The name itself says what is funding risk is, as the answer is being highlighted in red color, that is the B option. Okay, just see here. Funding risk is a type of which risk? It's a type of funding. It's a type of liquidity. Name itself suggests funding risk is a type of liquidity risk. So it highlights the risk that like you can say a bank may not be able to raise sufficient liquidity resources to meet its expected and unexpected also outflow requirements at any given point of time. I will just repeat once again what I said. What is funding risk? Funding risk is a type of a liquidity risk. Why? It highlights the risk that a bank may not able to raise its sufficient liquidity resources to meet its expected as well as the non-expected or unexpected outflow requirements at any given point of time. That's why the answer is B. Inability to meet the unexpected outflows like premature closure or non-renewal of deposits. The next comes the risk. That's the next question comes the risk that originates from mismatches in the maturity pattern of assets and liabilities is called dash. That is very simple. The answer is liquidity. But just see why liquidity. So maturing liabilities. What is maturing liabilities means? Fixed deposit or term deposit maturing on any given date or given day. Okay, so have to be settled by the bank. That is the outflow of funds will be there for the bank, right? So what is maturing assets? Assets means a term loan installments, you can say, due from the customer or from the third person on a given date or given term, or investment in government securities that are maturing. So bank should not give. Someone should give, either government, either some other person. So have to be realized. That is for the bank, it will be an inflow. It will be an inflow of funds for the bank. So if there is a negative mismatch between the amount of outflow as well as the inflow in a particular term, then the bank faces the risk of liquidity. And the bank faces the risk of which? Liquidity. It faces the risk of liquidity because if it will be negative mismatch between the amount of outflow and inflow. Okay, then the bank will face a liquidity risk. The next comes the what is exposure measure? What is exposure measure? Exposure. The name itself says what is exposure measure? Exposure measure used for leverage ratio. Please keep in mind exposure measure. I've already said you in a previous slide, not the previous video, previous slide itself I have mentioned you capital measure divided by the exposure measure. Keep link of it. Exposure measure, what it comes on and off balance sheet will come, right? Including the derivative exposures and the security financing transactions. Keep that in mind and be focused here. You will get the answer. See D, that is the exposure measure. What is it? Answer is D, right? D means both A as well as B option. So exposure measure itself means it's used for leverage ratio calculation, which is included on balance sheet exposure, off balance sheet exposure, which will also include off balance sheet. Off balance sheet exposure. Off balance sheet will include derivative exposure as well as the securities financing transactions. Securities financing transactions. We will move back now to the next slide. In that we are having more questions. We will just solve the one. Now see here, my dear friends, just see here. Now we are in the 36th question, that is question number 36. So read the question first. Funding of long-term assets by short-term liabilities. Long-term assets by short-term liabilities, it will create dash risk. It will create which risk? It will create a liquidity risk. Okay, but why it will create a liquidity risk? See, if the long-term assets are funded through like raising short-term liabilities, it will create liquidity risk, right? The short-term liabilities, as I said, will have to be settled on their maturity unless they are rolled over, or it may be replaced by new liabilities raised to facilitate the settlement. Otherwise it will be a liquidity risk for the long-term assets. So see here, funding of long-term assets by short-term liabilities. Okay, long-term assets, for funding them by short-term liabilities, it will create a liquidity risk. It's because, see here, if the short-term liabilities will have to be settled on the maturity, it will create a liquidity risk. Or else, if it's not maturing or it is not settled on the maturity, then they may have been rolled over or it may be replaced with the new liabilities. In that case, it can raise to facilitate the settlement. If a short-term liabilities are not rolled over or the bank is not able to replace, you can say replace them by raising fresh liabilities, then it may find it difficult to settle the matured liabilities. Thus, the long-term assets may have to be liquidated with adverse impact for the bank. Moving back to the next question, which committee is responsible for the product pricing both for deposits as well as the advances, in addition to monitoring the risk levels of the bank? Which committee? Committee itself is it's only a one committee, that is Assets Liability Management Committee, ALCO will call. Okay. See, which committee? So, committee's name is ALCO. Assets Liability Management Committee. Assets Liability Management Committee. See, which committee is responsible for product pricing both for deposits as well as the advances, in addition to monitoring the risk levels of the bank? So, answer is B. Why? Because ALCO is responsible for managing the assets and the liabilities by fixing the interest rate he will fix on both advances as well as on deposits. Moving back to the next question. The second last question of this slide. The main components of market risk are dash. See here, the main components of market risk. Market risk will take into liquidity risk, interest rate risk and currency risk. These three risks it will come in force. Okay, so the answer they have given in 4 parts. See, A, either it will be only 1, that is liquidity risk. Either it will be 1 and 3 in liquidity and currency risk. Either it will be C option, that is all the 3, interest rate, liquidity and currency. And the fourth option will be 2 and 3, interest rate as well as the currency risk. So the answer here is C option, that is all the risk will take into force, or it will come into force as a part of market risk. Okay, moving back to the last question of this slide. Dash is the difference between the RSA and RSL. See, what is RSA? Rate sensitive assets. Rate sensitive assets. RSL, rate sensitive liability. So, dash is a difference between the rate sensitive assets and rate sensitive liabilities, and is said to be positive when RSA is greater than RSL. There are 4 options given. So the answer is the first one. Why? Because interest rate sensitive gap is defined as RSA, risk sensitive assets minus risk sensitive liabilities. Risk sensitive assets minus risk sensitive liabilities. Now friends, this is our last slide for the video. Just see here, we are in 40th question. 40th question. Read the question. Bond with BBB rating, that is bond with BBB rating, will carry lower interest rate than one with AA rating. Is it true? No, it's false. Than compared with AA rating, it's false. Okay. See why? Because BB, what is BB indicate? BB rating borrower is more likely to be default than the AA rated borrower, right? As the default risk is higher, the credit risk for the bank is investing in a BB rating, you can say like BBB rated bond, is also higher. Now the higher risk has to be compensated, right? It has to be compensated by a higher interest rate on the bond when compared to an AA rated borrower. That's why this is true in nearly all cases, and hence the answer is A. It's false here. However, there will be exceptions. In everything there will be a few exceptions to the general rule. I will give you one exceptions to it. For an example, let's suppose if the BBB rated bond offers tax concession, okay, tax concession for the let's say for the investors, then the interest rate on the bond would be lower. Definitely then the interest rate on the bond would be lower. But in general, if we see, bond with BBB rating will always carry lower interest rate, okay, will always carry lower interest rate than the one with AA rating. It will be true? No, it will be always false, because BB rated borrower likely to be more default risk, more at risk than the AA rated borrower. Then moving back to the next question, that is expand IRRBB. Expand IRRBB. That is the full form of IRRBB. So what is IRRBB? It refers to IRR means interest rate risk. BB means banking book. Keep in mind clearly, IRR interest rate risk on BB banking book. Interest rate risk on banking book. The banking book is together with the trading book represents the total balance sheet of a respective bank. Now see here, trading book. What is trading book? I am making you clear the concept. Trading book, for a purpose of, let's say, capital adequacy calculations, it consists of the following. There may be securities would be there. There may be securities held for trading or securities under the available for sales category. There may be different categorization, sales categorization, trading categorization. There may be for open foreign exchange limits, trading position in derivatives, derivative entered hedging trading book exposures, and many are there. So for this called in the trading book, it will be there. So derivative transactions entered into by the bank for hedging a banking book entry are also considered or are also a part of the banking book. Thus IRRBB is nothing but interest rate risk. IRR, interest rate risk on banking book. Moving back to the next question, which of the following statements is correct in respect of assets under trading book? So see, there are given options here. The answer is the last option, that is D. B and C will D option comes the options B and C above. So what are the options B and C? We will see here now. See, assets in the trading book does not or do not include investments meant to be held till maturity. See, held till maturity means HTM securities. Held till maturity. That means HTM securities. Keep in mind the term. Assets in trading book do not include investments meant to be HTM. That is held till maturity securities. The assets in the trading book are M to M regularly. M to M means mark to market. M to M. That is also one of the terminology which you need to understand. See, the assets in the trading book are M to M and not HTM. HTM means held till maturity. MTM means mark to market regularly. So what is that M to M? M to M means calculating the current value of the asset as per the current market price and providing for appreciation or depreciation, any will be there as per the guidelines they will provide. So this is M to M. The next question, the last question will be interest rate. Is the interest rate risk is a type of dash. Interest rate risk, okay, IRR is a type of which risk? Dash. The answer is market risk. Why? Because it's a type of market risk. It addresses the main question, how the bank will be affected if the interest rate changes. If the interest rate will change, like lower, higher, anything. If the interest rate will change, how the bank will address or how the bank will be affected. So what it will say, interest rate risk is a type of market risk. Interest rate risk is a type of market risk.